So we are in day 3. This is going to round out our representation training. And it's actually, like I said to you guys yesterday, it's one of my favorite topics to cover is really helping you understand how do you apply this in a real world? How do you assist your clients with tax resolution options? And of course, you have to know this stuff for part 3 of the special enrollment examination. All right. So we're going to dive right in here. So the first thing that I want to talk about is building the taxpayer's case, right? So if you just have somebody coming to you, they're not, undergoing any garnishments yet, right? Their, bank account hasn't been touched, their paycheck hasn't been touched just yet. What you want to do is you want to have a process that you're going to build the taxpayer's case. So the first thing, of course, is going to be your consultation that you're going to have with the client. This is going to allow you to gather all the facts from them, understand how much they get paid and understand, how much income or, how much money in essence they have in their bank accounts. You want to understand their assets. Pretty much everything that we were looking at the other day on that 433F is a lot of the information that you want to get from your clients, right? Because we need to see like where are they at financially so that we can help them choose the best tax resolution options for them. Now, you are going to have an engagement letter. And the first part of this is just a discovery phase, right? You're just going to say, hey, let's just figure out what you need to do to be compliant. So that means, what tax forms do you need to file? What compliance measures do we need to take? How much money do you owe? And for what tax years do you owe them for? This is all going to be a part of your discovery, and you want to collect at least a minimum of $500. Most people can collect more, of course. $500 just gets you to complete the discovery of the taxpayer situation. From there, you're going to pull your transcripts, you're going to gain authorization. And again, that's where we're going to call the IRS to gather any additional compliance. I was telling you guys the other day, oftentimes clients, they, don't lie to us. They just really don't know where they stand with Internal Revenue Service, right? They don't remember all the forms that they've received or all the notices that they've received. And so it's really incumbent of you to not only pull the transcripts, but also speak directly to an IRS agent. Remember, you're going to call the IRS practitioner priority line so that you don't have to, it's still a wait, but it's a lot quicker. Normally, if you call first thing in the morning, you can get through to somebody within the first 5 to 10 minutes. It's super quick. Another little hack that you might want to do is you want to batch all of your telephone calls in one call. So for example, if I'm working with multiple clients, I might go ahead and call the IRS that one morning, and I might just speak to that one IRS agent and go through all of my client files, 2 or 3 client files with that agent. That would be a great way so you don't have to keep calling the IRS. You try to batch your calls, you try to batch your work so you can kind of really spend the remaining of that time being productive and actually implementing a lot of these resolution options for your client. So after you understand, from the IRS, what all forms that needs to be filed, because the IRS is going to say, hey, okay, they need to file 2021 1040. They need to file quarter 1 and quarter 2 of 2023 940s or 941s, right? So they'll let you know specifically the form and the year down to the quarter that your client needs to be compliant with, and they'll let you know the estimated balances due for each one of those. Once you have all this information, right, you analyze the transcripts, you understand, what they need to file and how much proposed, tax debt that they have. Now you can go ahead and analyze the tax case. This is where you look at all the facts for the client to say, okay, based upon this client's financial situation, their income, their assets, their future ability to earn income, and based upon their current tax situation, what are the available resolution options for them? And you want to help your clients, you want to choose the best resolution options for your clients, and of course, educate them on staying compliant in the future so they aren't back into this, mode of owing the IRS and trying to figure out tax resolution options. Once you have your resolution options available and obviously you're going to present the best option available to the client, that's where you're going to meet with them. You're going to collect any remaining fees that you might, have specified or outlined in your engagement letter. And you're going to go over those resolution options with your client to say, hey, based upon this information, based upon our discussion with Internal Revenue Service, here's what you're required to do. Here's what is required to be compliant. And here's a resolution option available. Now, what that really sounds like in real life, it sounds like, hey, Mr. and Mrs. Business Owner, the IRS says that we need to file your personal 1040 return for tax year 2022. They also said that, your 940s for quarter 1 through 3 need to be filed for 2023 as well to be compliant. And you owe so far $30,000 on the individual side and about $27,000 on the business side from past due tax liabilities of tax returns that you file. So first things first, we need to get you caught up with Internal Revenue Service as far as your filing requirements. And then secondly, once we file those returns and kind of see where your tax debt is going to fall at, here's where we estimate it to fall at based upon the information that you've already told us, then we can really put you into the best tax resolution option for you, which at this time looks like it's going to be an installment agreement. Once you present the scope to the client and the fee associated with that, because obviously if you're filing taxes for the client, you're filing payroll forms, 940s, 941s, that's going to be an extra fee that you're going to have to charge. And you want to make sure that this is an additional engagement that you create with the client to specify what you are going to do and what you're not going to do. Once they pay you for this additional scope of service, now you can go ahead and let your client know the timeline, the turnaround time for those services to be completed. So if you're doing, for example, their personal taxes, their business taxes, maybe you're getting them caught up with their payroll taxes as well. You let them know, hey, Mr. and Mrs. Such and Such, it's going to be a 7-day turnaround for your 1040. It's going to be another 7-day turnaround for your 1120. And it's going to be a 5-day turnaround for your payroll form. So total, what's that? I don't know, it's about, 19 to 21 days that, we're out of from completion of your work scope, right? Whatever it is, just put yourself some buffer in there. So if you estimate it's going to take 21 days, let them know it will be, the turnaround time will be 30 days. We tend to want to under promise and over deliver. Always give yourself some wiggle room just in case something comes up or in case you need additional forms or the client is moving slower than expected. You want to give yourself that extra wiggle room to, buffer in any additional points that you need to consider. Once that's completed, now you just continue with your resolution options, right? Whatever the resolution option you discovered was the best option for them, you go ahead and proceed with that. Again, they're going to pay you for your resolution services, for the implementation of the resolution services. So you got to think about, I tell clients tax resolution is similar to tax planning in a way, where tax planning has 2 parts to it, right? You have your first part where you have your tax plan. So this is where you're going to see, okay, what credits are available for your business? What deductions can we optimize for? And what timing of activities, timing of income, timing of expenses can we, manipulate in essence to help us pay the least amount of taxes? And what other tax strategies can we layer with this, right? What entity election, are you in the best entity right now? Should we, do an entity analysis where we look at, S Corp versus C Corp versus sole proprietor, for example. So this would be your all-encompassing tax plan, but then you have the implementation of that plan. So they'll get the plan, but then if they want you to change their entity, for example, from a Schedule C to an 1120S, right? That would be an additional fee. If they want help implementing a retirement account, right? An IRA account, that would be an additional fee. So tax resolution is very similar because you're saying, hey, we need to first find out what's up with your tax file, what's going on, what compliance measures need to be taken. Once we know, we're going to present that to you. And then we have our tax resolution implementation, right? This is your compliance work, getting those tax returns filed, those payroll returns filed, bringing you first compliant with the IRS. And then you have part two of your implementation, which is, getting you, the best resolution option with the IRS, whether that's an installment agreement, whether that's an offering compromise, and so forth. That's that part two of that implementation, all of which you will be charging for, right? You're going to be charging for this every step of the way. And you're going to make sure that you have your engagement letters every step of the way as well. So let's look at the tax resolution options. So the IRS is going to want you to understand your taxpayer's ability to pay the tax. So if we have a client and based upon that client profile, they're going to fit into one of these three resolution options, right? The first one is an installment agreement. It was over 60 something percent of the people with tax resolution options are going to fall into this category. That means they don't qualify for an offering compromise and they don't qualify for currently not collectible CNC status. So the majority of taxpayers in the United States that owe tax debt, this is going to be their primary option. Why? Well, because they have the ability to pay their tax debt back within the allocated timeline, right? Which is generally 72 months that the IRS wants you to be able to pay in full your tax debt. So this one is fairly simple. Let me show you what it actually looks like from here. And so we'll go to just Google IRS installment agreement, and then it should be 9465 right here. This is what the form looks like. And it's a very simple form. It's a 2-page form. I've had people say that they charge anywhere between $500 and $2,000 for this form, with an average being, on a low end, an average being about $500, on a high end, an average being about $1,500. So you got to understand, yes, a client can do this themselves, right? They can fill this form out themselves. It's 2 pages. They can call the IRS themselves and get an installment agreement request. So you give them the option. If they want you to do it, this is going to be your fee, right? Your fee could be $250 or $350. Oftentimes, clients just want to make sure, clients that see value in paying are clients that want to make sure it's done right. Those are not the type of clients that are going to want to take your chances. They want to make sure that they're getting the best possible deal, right? The best possible options available. So the people that are going to pay this are going to be your ideal clients. And of course, there's going to be a segment of the market that's going to be like, I just do that myself. Sure. Go ahead and do it yourself. And if you need any other assistance, you can invite them to contact you when they do need further assistance. But the installment agreement, this is generally for your people that owe less than $50,000. You're going to put their demographic information up here. First name, last name, social security number, telephone number, address. You're going to put the total amount that they owe right here. And then what it says subtract a line 8 from line 7, which is your result, but you're going to divide that by 72, right? So let's just say they owe, I don't know, $30,000. That's going to be on that line. And you're going to divide that by 72. So what's that math, guys? 30,000 divided by 72. That's about 400. We're going to round it up to $417. Yeah, thank you, Karina. So 417. So this is the minimum amount that the IRS wants to collect on this debt per month. The majority of your clients can afford the minimum amount. There are exceptions where, you can ask for a reduced amount if they truly can't afford it. But this is generally going to be comfortable for a lot of people that owe some tax debt. So from there, they get to choose what day of the month they will like the payment to come out. So you will put that on here, enter the date you want to make your payment each month. So you could put any days between 1 and 28. So maybe they want to pay this every 15th of the month, for example. And then you could put their routing number, their account number. The best way to do this is to make sure that it's being auto debited, because if they default on an installment agreement, it's going to kick up collection activities again, right? The IRS is going to come after them. They're going to put a lien and then start to levy their assets. So I tell clients, listen, you don't want to try to remember this and then make a mistake and accidentally forget. So just put them on ACH. So put their routing number and account number right here. So it's automatically going to come out of their account. And yes, you can put less than 72 months. So you could pay more. Absolutely. So if your clients want to pay more, if they're like, hey, I want to hurry up and get this tax debt off my record, you could put whatever you want. It's just the minimum would be that 72 month. Like that would be kind of like the minimum amount that they want. But if you are more than welcome to, obviously the IRS would more than welcome your clients to pay more. If your clients do owe over $50,000, they generally want to see Form 433F attached to it. Since COVID, they've been really lenient on this. They haven't been asking for this. So you know, I don't know how long they're not going to ask for this, but as of right now, and for the past couple of years, they had actually increased it. They weren't asking for 433F upwards to like $150,000, right? Since COVID happened. So, but generally, if your clients owe over $50,000, they generally want to see, okay, how much can you truly afford? Because they just want to make sure that, you know, your clients really try to pay off this balance before the time frame. Now, what's interesting, so even if they do owe over, let's just say they owe $100,000, for example, we divide that by 72 months. That's about $1,300 a month. The IRS is going to want to see if your clients could generally pay the minimum amount within that 72 month, then you know they generally don't ask for this unless you're trying to go for some reconsiderations, you're trying to lower your payment amount. So this is your process for your installment agreement request. And so what I want to do is we're going to go through some activities after I go through this, because I'm going to go through some different scenarios with you so you truly understand, okay, what type of client would this apply for, right? The type of client this would apply for is people that can afford the minimum amount and they don't qualify for any other option, right? So let's move on to our other options. So our second one is our offer in compromise. So you guys heard those commercials, you know, do you owe the Internal Revenue Service over $10,000 in tax debt, right? You could get started with our Fresh Start program, or the IRS's Fresh Start program. Well, this is called an offer in compromise. And this is where your client, I really like to tell it this way. It's like when your clients are broke, they don't have any ability to pay the Internal Revenue Service. The Internal Revenue Service is not likely to collect on this debt within the CSET period, which is their collection statute expiration date, right? Remember, generally they have 10 years to collect. There are certain activities that's going to extend that, but the general CSET is 10 years. And so if the IRS sees like, oh man, we are not likely to collect this tax debt from this person because they don't have any assets, they spend more money than what they make, and we are unlikely to collect this debt within our CSET period, they don't have any future, you know, ability to earn a substantial income. These are the folks that qualify for offer in compromise. So when you look at the data that the IRS releases annually, you see that less than 35% of the people that apply for an OIC actually gets accepted for an OIC. So, you know, 30 to 35%, and I think I seen one statistic, it was as low as 27%. About 30% of the people are only going to get approved, right? So that means 70% of the people are going to go into one of these other two buckets, right? And one of which we already spoke about. So when we're thinking about the offer in compromise, the IRS has a beautiful offer in compromise tool that you can pull up on their website to help pre-qualify your client. It's called the Offer and Compromise Pre-Qualifier. Now, one of the things that you need to know is your client cannot be in open bankruptcy, right? So if they're currently in an open bankruptcy proceeding, they need to wait. So are you an open bankruptcy proceeding? No. They do want to make sure that all required federal tax returns are filed. So for example, we called the IRS earlier in my make-believe situation that I was discussing with you guys. And the IRS agent said that our client needs to file that 1040 and his 940 forms, his payroll forms. Well, if those haven't been filed yet, we can't even look at an offer and compromise. So we first need to make sure that the client is compliant. They are caught up with all of their federal tax obligations, right? So have you filed all required federal tax returns? Yes. Have you made all required estimated tax payments? Again, if your clients are supposed to be making estimated tax payments, they need to do so. If it's not applicable to them, then you can hit NA. And then if you are self-employed and have employees, have you submitted all required federal tax deposits? This is those employment tax forms. You're going to hit NA or yes, depending on the situation with your client. Now it's going to take us to page 2, which is our basic info. So let's just say 90810. Let's say we're in California. We're in Los Angeles County. 4 members in our household, no members over 65, total IRS tax debt, let's say it's 45,000. And what is the most recent tax year you are requesting to compromise? So generally just going to put the last filed return that you owed a balance on, or that the taxpayer owed a balance on. So we'll say 2022. And then you're going to hit next. Now it's going to ask for your client's asset. So remember, like I was telling you guys, in your onboarding, you kind of want to just collect all this information up front. And it's really easy to do that over a quick 30-minute phone call where you're getting all this information from the client, their assets, real estate, credit cards, bank accounts, their monthly living expenses, all that good stuff. Because that way, when you're actually going to view their resolution options, you don't have to go back and ask them, oh, wait, but how much do you have in your bank account? Oh, wait, how much is your home worth, right? You already have all that information up front. So let's say total bank balances is $500. Their total home market value, let's say it's how much should we put for their home market value? Type in chat. Get you guys helping me out with this. Let's see. If they have a home, do they have any equity in it? Or what's the market value for their home, rather? All right, $350K. And then how much do they owe on the loan? $100K, Nathina? So we'll put $100K that they owe. Do they have a vehicle? Do they have any equity in their vehicle? Let's say maybe they have $3,500 equity in their vehicle. Do they have a retirement account? Does our imaginary client have an IRA or 401k? No? Okay. And any other real property, any other assets, stocks, bonds, miscellaneous that your clients will have? Do they have an airplane or motorcycle? No. All right. So let's move on to this next page. Let me see if I put in 100,000. Yep. And 350. Yep. All right. Next page. So it automatically, based upon what I told them, it says you do not qualify for an offer and compromise based on the information you provided. Your equity and assets is sufficient to pay your tax debt. You see that? You reported $254,000 in equity in your assets, and your liability is $45,000. So what the IRS wants your clients to do, they want them to go get a home equity loan, go get a line of credit, go get a personal loan. If they see that you have substantial assets that you can use to acquire debt, they want you to go take that debt. I've had an IRS agent tell me my client can apply for an offer and compromise because she had money in her retirement account. I said, well, yeah, that's for retirement. And she was like, yeah, so tell her to take it out and pay her taxes. I said, but then she's going to owe more taxes because she's not retirement age. She said, so like it's equity. She has it. It's cash. It's available to her to pay her tax debt. She needs to take her IRA out and pay her taxes off. So That's just an example. When you start dealing with this stuff, the IRS, if they see that your client, and this is why only 30% of people qualify for offering compromise. If they see that you have assets, they see that you have ways that you can access this, even if it requires you to take on debt, such as a home equity loan or line of credit, they will want you to do that before they write off this debt for you. Now, the people that qualify for offering compromise, this is going to be the people that, like I said, they're insolvent, right? And that's a nice way to say broke. They are insolvent. They don't have any assets. They spend more in expenses than they make in income. They live paycheck to paycheck. Like, this is the profile that the IRS generally approves for an offering compromise. These folks can get their tax debt wiped down to zero. Now, I don't want to get into how people, because I've heard of some people, they owing like crazy numbers. Like, somebody was like, yeah, they owe like several $100,000 and they were able to settle it for zero. Okay, well, first of all, if your client owes $700,000, at some point they were making some revenue, they were making a lot of money. And so it's not impossible. Maybe that person did become destitute, right? Maybe they did become insolvent and now they're hard on their luck and they don't have anything, right? They, filed bankruptcy, or they, their business totally went to catastrophe. That's possible, but that's the profile that the IRS wants to see. They want to see that this person, that they are unlikely to collect this tax debt within their collection statute period. But then there's that other group of people. Then we have the currently not collectible people. This one is a little bit different, right? Because you have somebody that they have too much assets to wipe off their debt, but they can't afford an installment agreement, right? You got these people that fall through the cracks between these two resolution options. So what do we have for them, right? Well, the IRS has the currently not collectible status, or the CNC. So if a taxpayer is unable to pay their tax debt due to financial hardship, they may qualify for the CNC status. So this is what's going to happen. Let's say your client owes several $1,000s to the IRS. They can't afford a payment plan right now because they just got laid off from their job. And, they are spending more money than what they're actually making in, right? The little unemployment check that they're getting in is just not cutting it. So they can't afford to pay an installment agreement. But they don't want their unemployment checks to be garnished, or any bank accounts, any $5 in their account to be garnished, right? So we say, okay, let's put you on a CNC status, which is going to suspend the collection activities by the Internal Revenue Service. However, you will still incur interest, right? The balance is still going to grow when the client is on CNC status. So you do want to let them know that up front. But at least the IRS would give them generally 1 year, 12 months to get on their feet, to where now they can transfer that person to an installment agreement after they are gainfully employed. This is also if, maybe they got sick and they can't afford their installment agreement anymore. You could put them on a CNC status. It has to be some sort of financial hardship. So just think sickness or unemployment or some other life event, right? It could be something, it could be a hurricane that, devastated their area and they need some sort of reprieve temporarily until they get back on their feet. They can qualify for that CNC status. So this is for those people that fall through the cracks, right? Now, again, this is going to be for that very specific person that doesn't qualify for offering compromise, but they can't afford an installment agreement. They're going to go on CNC status. So you, as the EA, your role, you're doing a lot of financial analysis, right? You guys notice that? You're looking at their financials. How much money are they making? How much are they spending in monthly expenses, right? Because if we go back to the actual 433F, for example, the IRS, even when you do the offering compromise tool, is going to ask for these expenses, right? Food, medical, transportation, housing and utilities, and other. Now, the IRS does have allowances right? And these are called the Allowable Living Expenses National Standards, right? These are updated every year to adjust with inflation. So what the IRS says is we're going to automatically give you a bare minimum amount or an allowance amount for these different expenses that you might incur in your household. So if you have 3 persons in your household, they're going to give you $936 a month in food, $85 a month in housekeeping supplies, $200 in apparel, $91 in personal care, and $381 in miscellaneous, for a total of $1,700 in allowable living expenses. So what that means is if your client is making, I don't know, $2,000 a month, for example, the IRS is going to give them $1,700 off rip for their allowable living expenses. Now, your client's living expenses might be more, but it definitely needs to be within reason, right? So the IRS says that they're not going to accept, tuition, right? If your kids are in private school, for example, they're not going to allow that, right? If you're eating out at Ruth Chris, every other night, they're not going to allow that in your, living expenses. So they are going to give you some wiggle room, but it has to be within reason. It has to be within reason. So when you do that offering compromise, it automatically is going to allocate these allowable living expenses in the equation to see if your clients qualify based upon their household size. So you think about it, you're looking at a lot of information. You're looking at their income, their assets, their liabilities, so you really have to get great at assessing your clients and really choosing, really fast, just based on the facts that they give you, what resolution options are available to them. Now, as the EA, you are going to be representing your clients, right? You're going to be representing them. So let's make this a little bit bigger. You are going to be representing their clients in their interactions with the IRS. You're going to negotiate on their behalf. They can advocate for the taxpayer's ability to pay. You're going to present relevant financial information, and you're going to work towards a resolution that is fair and manageable for the taxpayer. So when you get into the full-blown resolution, so in the beginning, you might want to only just do an 8821, right? We might just want to only do a tax information authorization form, which just allows us an opportunity to get all of the facts in our discovery phase. Once the client signs your engagement letter and makes their retainer deposit for tax resolution services, that's when you might want to, of course, you're going to transition to your, what's the number, guys? 2848. Let's see if you've got that number. That 2848, you're going to transition to your power of attorney. And that way you can actually speak on the client's behalf, speak on their behalf. So bankruptcy, we talked about that. We just said that, if your client is in open bankruptcy, they can apply for the offering compromise. They need to have that resolved. But there are situations where your clients might want to file bankruptcy for their tax debt. This is an option for them. Excuse me. I would say it's one of the last tax resolution options that you might want to consider for a client, because it is, obviously more time, energy, money to go down this route. Plus, there are very specific stipulations for this. So your clients, they generally have to have already, owed the Internal Revenue Service for at least 3 years, right? So let's look at Chapter 7, for example. So Chapter 7 is going to completely wipe out their tax debt. The tax debt must be for income taxes. So it can't be for other taxes like payroll taxes or fraud penalties. And the tax debt must be at least 3 years owed based on the tax return filing deadline or the actual filing date, whichever is later. The taxpayer must have filed a legitimate tax return, so it can't be frivolous, is what they're saying. And the debt has to be at least 2 years before filing for bankruptcy. The tax assessment must be at least 240 days owed before filing for bankruptcy. And that's all for your Chapter 7, where they can qualify if they meet these parameters to get their entire tax debt wiped out. You do have Chapter 13 bankruptcy, which generates a repayment plan and potentially pay them off at a reduced amount. So depending on the taxpayer's income, expenses, assets, this might be, the second option that they might want to consider. Let's look at a few scenarios. All right. So let's talk about this client. Let's go over her profile, and I want you to type in the chat which tax resolution option would be better for her. So this is Mary. She owes $26,000 in taxes. She's 43 years old, divorced. She works at Pepsi as a controller. She makes $168,000 salary. She owns her home, valued at about $250,000. She still owes about $216,000 on it, so she has about a $34,000 equity. She has an IRA of $34,000, stock options with Pepsi of $52,000, and she has 4 children. She has about $14,000 in her checking account and $6,000 in her savings account. What option do you think is the best option for Mary? Yeah, installment agreement. Right, installment agreement. Why? Well, she only owes $26,000, and I'm not saying that's a little bit of money, but $26,000. But look at this. She makes $168,000 a year. So the IRS is going to actually look at her ability to pay. Like, we are confident that based upon her salary, that this lady can afford to pay us this $26,000 within our CSAT period. That's one. Right. Number 2, she has equity. She has $34,000 equity in her home. The IRS is going to be like, go get a home equity loan, go get a line of credit, go get a personal loan, whatever, and use your equity, use your collateral, use your home as collateral. Or they're going to say, hey, Mary, take it out of your IRA. We see you got $34,000 in the IRA. Go ahead, withdraw that out. And we don't care about the additional penalties that you're going to incur because you're not retirement age yet. Stock options, these might be tied up. She might not be able to have access to this because, your stock options are normally going to be vested over a period of time. But if it is liquid, she, obviously the IRS is going to want her to exhaust all her possibilities. And then she does have substantial money in the bank, right? She has $14,000 in checking, $6,000 in savings. So if we somebody do the math for me, $26,000 divided by 72 months, what's her minimum payment that she would pay on a payment plan? Somebody do the math for me. 361. Yeah. So she has more than enough money in her bank account. I would even encourage Mary to pay a little bit more. I would probably encourage her to pay 500, 600, 700, whatever she really could afford. I would say, listen, let's be aggressive. Let's get this off. Because why? Why do we want to encourage her to not pay the minimum? Why shouldn't she take the whole 6 years to pay this? Yeah, interest and fees. Mary might be better off going to MasterCard or American Express and getting a 0% interest card for a year and transferring half of this tax debt. She could probably get like a $5,000 or $10,000 card from like Amex or something like that, Chase Bank, Bank of America, Wells Fargo. They, a lot of times you can get a deal at 0% interest for 6 months or 0% interest for 12 months. She's going to save hundreds, if not thousands of dollars in interest by just transferring it to a credit card that has a lower interest rate and paying off the credit card over time. Honestly, because if you look at the interest rates and how they compound with the IRS, it's much cheaper to go with the credit card oftentimes. Or we might encourage her to take out a HELOC loan. The interest rate on a HELOC, what the interest rates are going for, 7-8%, whereas your tax debt is anywhere between like 18 and 25%. So she might even be better off doing that and just paying off that loan right there. So we just want to encourage her. Yes, she qualifies for an installment agreement, but you do want to let her know that, she might want to exhaust other possibilities or be aggressive on her repayment options so that she can save the amount of money that she pays back over time. Great job, guys. So let's look at John. John was laid off at Fidelity. He owes $13,000 to the IRS. he was a loan officer, a mortgage loan officer that was making $80,000 salary. He has about $150 in his checking. Don't judge him. No savings. He does have a Mercedes that he still owes $20,000 on. He's renting, and he has about $10,000 in stocks. What is the best option for John based upon this profile? Yeah, you guys got it. A CMC, right? A currently not collectible. Why? Why do you think that would be the type in chat one or two considerations that the IRS is going to look at? More specifically, because I see some people put in OIC, why wouldn't it be an OIC? Somebody let me know that in the chat. Why wouldn't we do an OIC for him? His ability to make income. Yeah, his ability to make income. We see that, oh man, no, he can get up there on income, 80,000. His situation is temporary. Yeah. He does have those stocks. You have 10,000. Yeah. So he wouldn't qualify for an OIC because he does have assets that the IRS will want him to liquidate to pay off this tax debt. And the IRS will look at his future ability to pay. IRS is saying, oh, you're a loan officer. You were making $80,000. You just got laid off. Okay, we'll give you 6 months or we'll give you a year. But we think based upon your earning potential that you could pay off this $13,000 within our CSET period. So we'll be more than happy to continue to charge you interest over the next 12 months while you get on your feet, sir. That's what the best option would be for him. Yeah. All right, let's look at Ethel. Ethel is out here living her best life, but guess what? She owes Internal Revenue Service $17,000. She's retired. She's on Social Security. She gets $1,000 a month in her SSI or SS. Is it Social Security? Is it SSA? She gets $1,000 SSA. She has $800 a month in rent, about $100 in food, $100 in clothes. She has no savings. Pretty much Ethel, she's living, Social Security check to Social Security check. What is her best option for Ethel? Yeah, you guys got it. We would really go to bat for Ethel to get this tax debt wiped out. 17,000. So what are the factors that would help us substantiate an offer in compromise? Type it in the chat. What are the factors that would help us substantiate to say, IRS, you need to take this deal? Like how will we plead our case? Yeah, Shavonda says she only has SSA income. Absolutely. She's only getting $1,000 a month. And she's retired. She doesn't have an ability to earn. And her, okay, if we look at Ethel's future ability, what could Ethel do at 72? Not saying that she can't be gainfully employed anywhere. I mean, heck, because some of our presidents right now are in their 80s. So we're not saying that she cannot be gainfully employed, but we look at the facts of the situation, right? Not everybody has the capacity to go out and be, in government. So we look at the facts of the situation. She's retired. Her only income is $1,000. She has minimum earning potential, right? And she spends more, if not the same amount of money that she's making. She's literally living paycheck to paycheck. She doesn't have any assets, right? She doesn't own her own home. So there's nothing to liquidate to pay this IRS debt. So this is all helping us build our case with Internal Revenue Service to say, hey, your likelihood to collect $17,000 from Ethel, who's 72 years old, living paycheck to paycheck with no assets, is slim to none. We need to settle this tax debt now. And of course, IRS is going to want you to substantiate that, right? They're going to want to see receipts, right? You're going to submit that over with your offer in compromise. Right. Ketra says she is insolvent. She is. No assets, low income, Jasmine says. So Digna says how it's determined how she can offer. So yeah, so let's talk about that, Digna. So the offer in compromise, you guys are going to use 656, the booklet. right here. And I love this because they really just walk you through the entire thing. So it gives you step-by-step instructions, who's eligible. It also gives you the process. So it is an application fee, but if they are low income, they don't have to pay a fee if they can be certified low income. And what it does, you're going to complete Form 656. You're going to complete the Form 433A for individual or 433B for business. Now, these are they're very similar to 433F, right? So 433F is your collection information statement. But if we pull up 433A, for example, whoops, I put that in wrong. 433A, this is your collection information statement as well, but it's specifically for your offer in compromise. Here we go, 433A OIC. This is going to be specifically for your offer in compromise. So it's going to look for the similar information, right? Their demographic information, their employment information, their assets. And then it's going to look at any continued assets, right? Real estate, stocks, bonds, vehicles, all that good stuff. If they're self-employed, they can put their self-employed information here. And then it's going to look at their monthly household income and expense information. And so what it does, it has a calculation that you use back here to calculate your offer, right? So it's going to take how much money you have, your future remaining income, and it's going to subtract it from your allowable expenses, and it's going to help you calculate your offer, which for Ethel could be $1, for example, you know? Like she might literally have a negative number here. And what the IRS says is your offer must be more than zero. So we'll put $1. Like if we did her income minus her expenses and assets, she's probably insolvent, or based on the fact she is insolvent. So her minimum offer would be $1. Some people's might be different, but you know, it's all going to be on their income minus their expenses and their equity and their assets. From there, you're going to sign off on it, have them sign, and then you're going to attach all of your substantiation, right? So the IRS is not just going to let you send this over and, you know, that's it. No, they want to actually see pay stubs, earning statements. They want to see your most recent statements for all of her sources of income. So they want to see Social Security, rental income, interest and dividends. They want copies of all of bank statements, right? They want to see what's been going on for the past 3 months or 6 months if it's for the business. They want to see this 433A or 433B if they're a business, and they want copies and receipts of all their other assets, right? So if they have any mortgages, second mortgages, vehicles, court orders for child support, alimony, trust documents, they want the receipts for everything. So what you're going to do, you generally make multiple packets, right? So you make a packet that you send to the Internal Revenue Service. You make a copy of that packet for yourself to keep for your file. And then you make another packet copy for your client, because you never know. The IRS generally comes back and they say, hey, can you send us this? Can you send us this? They might need additional substantiation. So you keep your own copy, you give your client a copy, and you send a copy to the IRS that they can review. Now, the IRS says that they have 24 months to render a decision on your offer in compromise. And if they don't render a decision within 24 months, that it automatically gets accepted. Well, that's pretty rare. I'm not saying it can't happen, it doesn't happen, or it hasn't happened, but they normally will give you some sort of decision within that timeline. I say that to also help you set expectations for your client, because you're going to let your client know, like, hey, the IRS has 2 years to, you know, render a decision. So don't think this is something that is going to be a 2-week or a 30-day process. It can take several months for the IRS to approve or ask for additional information or deny your offer in compromise. Great job, guys. All right. So we helped Ethel with that. All right. So let's move on to our next client. Why does it always start from the beginning? That's interesting. Our next client is Stephanie. So Stephanie is a teacher. She makes $50,000. She has 3 children under the age of 12. Her AGI after, she files her tax return is about 30,000, and she owes $5,000 in taxes. She doesn't have any Schedule A. So she has about $5,000 tax liability. What are we going to do for Stephanie? Okay. So a lot of you are saying installment agreement. What's the payment amount for Stephanie on $5,000 in 72 months? What's that payment like? $70, Maria? Okay. So what we would do, this one is Ty says tell her to just pay it off. Yeah, this one is a little bit you guys got the answer right. It definitely is an installment agreement, but I would still ask for additional information. You could get more information as far as how much money is in her bank account. You know, are there truly any other assets that we need to know about? But all in all, just based upon this and her ability to pay, we can also look to see what is her capacity right now. With her children, right? Like, she might live in a expensive area, like, I don't know, somewhere in California, for example, at $50,000 with 3 children. Oh man, like that's tough. So we can gather more information from her and really have a complete picture of her financial analysis or her financial picture. And then we can make the best recommendation from there. But based upon this, is $70, or Claudia more specifically, $69.44. She should be able to pay on an installment agreement. This will be her best bet on an installment agreement. The second option, like I said, that we might look at, we might, of course, collect all of our collection information statement from her, all of her financials. It's a possibility that she may be able to settle her debt, depending on how insolvent she is. It could be a possibility, yes. So I wouldn't totally rule it out, but I would definitely get more information from her. But based upon this so far, she's able-bodied. She's not retired or elderly. We're looking more so on installment agreement for this. Great job, guys, on that. And thank you guys for participating. So let's look at tax avoidance versus tax evasion. And I'll come back to the chat for any questions that you guys put in when we finish up this first section. So you need to understand that tax avoidance is legal. It is legal to avoid taxes, right? So type in chat, what are some legal tax avoidance strategies? Type in chat, give me an example of a tax avoidance strategy that is legal. Right, contributions to an IRA. Exactly. That is a legal tax avoidance strategy. If you look at your client's profile and you say, hey, Mr. Mrs. Such and such, if you invest in a traditional IRA or a Roth IRA, you can actually contribute up to the maximum amount for 2022 is $6,000, and you can get a deduction for that to help you lower your tax liability. Absolutely. Zachora says, making sure that you're claiming all of your appropriate expenses. Yes, making sure that you're accounting for, if you're on Schedule C, you're keeping proper bookkeeping. That's a legal tax avoidance strategy. Proper bookkeeping is a legal tax avoidance strategy. Yes. Taking all of your proper deductions. Absolutely. Contributions to an HSA. or a FSA, yes. Investing in real estate, absolutely, yes. That could definitely be a tax avoidance strategy. Donating to charity, yes. You're going to itemize that on your Schedule A. Absolutely. So these are all tax avoidance strategies that your clients can deploy. This is all going to go towards, tax planning. These are all legal ways that your client it helps them pay the least amount of taxes. Now, the IRS says, listen, we don't want you paying more than your fair share, right? The code has these legal tax avoidance strategies in them, right? The IRC has these tax strategies in them because they are to be utilized. And when you look at the tax code, you really need to look at it as a book of incentives, right? So the Internal Revenue Service is incentivizing taxpayers to take certain actions. We'll talk more about this when we get to the individual and business side. But so, for example, what's a part of the tax law that incentivizes taxpayers to hold on to their investments? What's one part of the tax law that incentivizes taxpayers to hold on to their investments? What is that called? When they hold on to their investments generally more than 1 year, the IRS incentivizes that behavior by giving them this. Okay. I'll let you know. It is, oh, Janelle. Janelle came through with it right when I was about to say the answer. Janelle, yes, long-term capital gains. Why, Janelle? Like, listen, long-term capital gains, you get taxed at a much lower tax rate than you do at the ordinary or short-term the short-term capital gains, right? Your short-term capital gains is going to be taxed at your ordinary tax rate. So when we go and we get to this part on individual or business, you're going to see like short-term capital gains, most people are going to be taxed anywhere between 0 and 20%. Whereas if you have over $500,000 in ordinary income, your tax rate can be as high as what? What's the highest tax rate right now? If you're making over like $550,000, type it in the chat, guys. Come on. I believe in you. Yes, 37%. Yeah, it can get really high. So you want to understand that the code, the Internal Revenue Code is there's a lot of incentives, right? And there's a lot of, what's the word, the opposite of the incentive, right? Somebody type in chat that word. I'm running a blank right now. But there's the book of incentives where they say, hey, we want you to hold on to your assets for more than 12 months because you qualify for the lower tax rate. We want you to invest in real estate, right? We want you to start a business. We want you to hire people because we give you, tax deductions. We want you to invest in your retirement because we give you, tax credits or tax deductions that you can take. Jasmine says a deterrent. Yes. So they'll deter you by imposing a tax if you do something that they don't believe will benefit the economy as a whole. They will deter you with certain activities. So the tax code is geared for all of us, your taxpayers, to pay the least, to pay no more than their fair share, right? No more than their fair share. Now, on the flip side of that, we have tax evasion. Tax evasion is, I'm not telling the IRS about this money or income. Tax evasion can be something as innocent seeming as a dog walker that makes a couple of $100 a week walking dogs because she enjoys it and she doesn't report the income. It could be something as simple as that. That's tax evasion. What else do you think tax evasion could be? What else do you think tax evasion could be? Ooh, you guys are saying tips. Yeah, if your client is getting tips and they're not reporting that income, that is a part of tax evasion. Yes, it is. All those little cash apps, those little Venmos and Zales and PayPal that people are getting and they're not reporting. The IRS says this is tax evasion. And they're trying to close the loophole on that too. We all know that. They're trying to close that loophole. Underreporting. Yeah. So Melissa says underreporting. So if I'm a dog walker, I'm making $500 a week. I might only report $200 a week. That's tax evasion. That is illegal. Right? What else did you guys say? You said lie about expenses. Yeah. If you lie and say that, you spent more on a certain aspect or asset that than you didn't or than you did, then yeah, that's tax evasion. Absolutely, guys. So you just want to understand this and be leery of working with people that want to encourage you to participate in tax evasion. Don't even be leery. Don't do it. It's not worth it. Right. So if a client is like, oh, can I report this next year? Right. I had a client ask me that she had won the lottery. And she was like, oh man, she was disappointed that she ended up owing like several $1,000s on her taxes because of the lottery winnings, and she didn't withhold taxes. When you win the lottery, they ask you if you want any federal taxes to be withheld, and you can opt in to have taxes withheld from your lottery winnings or your gambling winnings. You can opt in for that. She didn't opt in. She had got, it was close to 6 figures in winnings that year. Reported on what? What form was that reported on? It's a bonus question for you guys. And I put it on her tax return that year, and I was like, yeah, you owe about 10 grand. I can help you do an installment agreement. You could just, pay this off over the next several years. And she was like, oh, can I just file it next year? Can I just file that next year? Oh, so it's normally going to be reported on your W-2G. Digna got it right. Digna got it right. W-2G. I know some of you put in 1099, but it's going to be reported on a W-2G. Great job, guys. So what would you guys do in that situation? She's like, can I just report this next year? Can I just do an amendment? Can you just file my taxes right now? And then what I'm going to do is I'm going to come back in 3 months and I'm going to have you do an amendment, and then we could put the W-2G on there. Yes, 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 Areta. She says, nah, girl, we can't. No, ma'am. No, we can't. We can't do it. And don't do it. It's not worth it. Guys, it's not worth it. Your professional, we already talked about this, your professional standards, you as an EA, you can't do it. So you're going to politely decline and say, listen, I can file your taxes with what I know you currently have. Or you can go somewhere else, and that's it. So don't participate in this, in those shenanigans. Don't participate in the shenanigans. All right. So before we go to this next section of liens, levies, and seizures, let's go ahead and get some questions out of the way from this first section. You guys, we just covered a lot of information over the past hour. So I want to check in with you guys. What questions do you guys have about how do you assess tax resolution options for your client? How do you, identify which resolution option is best for them? How do you analyze their financials? What questions do you guys have about this? And I really want to make sure that you get this. This is really important for you guys to get, not only for the test, but for your career as an enrolled agent. So, Nathina, earlier you said, how does it work if she were to qualify for a refund the following year? That will cover that amount. Will the IRS just take the next year's refund? Yes, Nathina. So she could qualify for a refund next year. And let's say her refund was 3K, but her tax debt was 5K. That 3K will be applied to her tax debt. Yes. And we're talking about Stephanie for you guys. So remember, we're talking about Stephanie, the last lady that owed the $5,000. Melissa says, are you still paying in that 2-year waiting period for the offering compromise, or are payments paused? Okay. So this actually is one of the things that extends your CSET period. So what the IRS says is when you get an offer and compromise process, they pause collections, right? So they're not going to collect on your client. Your client doesn't have to pay anything, right? They should still keep up with their current tax obligations, right? So if they're supposed to be making estimated taxes, they still need to file all tax returns on time, right? Your client still needs to stay compliant. But what's going to happen is because the IRS is giving them that pause, it actually is extending the collection statute period, right? So for as long as that your client is on pause, it's extending the time that the IRS has to collect the debt from your client. So you have to understand that when you're going for an offer and compromise, it will extend your CSET. So, but yes, that's a really great question. No, the client is not going to pay on anything. They're just going to make sure that they stay compliant with their current tax requirements, their tax compliance. Jasmine says, can you combine an OIC with an installment agreement? So what that would look like is you wouldn't combine an OIC with an installment agreement. What you would do is just apply for an offer and compromise. And on that offer and compromise, remember I showed you guys how you're gonna do some math calculations. You're gonna take their total income minus their total allowable living expenses, and you're gonna get that amount. And then you're gonna times that by 12. That's generally how much they should pay back. Sometimes that number is a couple of $1,000s, for example. And what the IRS says, like if we go back to that booklet, they have a few options on how your client can pay that. So if we go back to that offer and compromise and we scroll all the way down here. So let's see. Oh, actually, let's come up here. So what they say is, can you pay in full? So generally the IRS will not accept an offer if you can pay your tax debt in full through installment agreements or equity and assets. So we already talked about that. They will take your tax refunds to offset your tax debt. What else? And then payment options. So you can do a lump sum cash payment. So this option requires 20% of the total offer amount to be paid with the offer, and then the remaining balance paid in 5 or fewer payments within 5 or fewer months. So that's kind of what you were saying is kind of, you kind of think of it as a hybrid installment agreement, but you're really saying, hey, I owe you, my offer, let's say, we got our tax debt down from $50,000 to $5,000, right? So what the IRS is saying is, okay, we want 20% of that on if you opt for the lump sum cash agreement. So that's going to be $1,000 up front that you're going to pay with your offer and compromise. And then they want you to make the 5 or fewer installments. So if $4,000 divided by 5, so they want you to pay $800 a month for the next 5 months. Now, going back to Melissa's question, okay, here's another example. Here's a caveat to that first answer that I gave you. If you are opting for a lump sum cash payment where, you're selling your tax debt for a few $1,000s or however much, it's still something that you end up having to pay the IRS once all calculations are ran. You should make these payments while your offer is being reviewed. So you're going to submit your 20% with the offer, but you're going to tell your clients to make these 5 payments even while their offer is under review. So yes, that's how you want to do that. You do want them to be compliant with the terms that you're submitting to the Internal Revenue Service, even though they haven't accepted it yet. The other option is your periodic payment. So this option requires you to make the first payment with the offer and the remaining balance paid in monthly payments within 6 to 24 months in accordance with your proposed offer terms. So similar to the lump sum, is just you don't have to do a lump sum. You just have to make sure that whatever amount you do offer them, that you're paying it monthly based upon these 2 time periods. So two parts to this. I just want you guys to make sure that you are getting this from me. If you're offering zero, there's no, or if you're offering $1, for example, there's no ongoing payment requirements that you would need to do. You're going to send your $1 in, and you're going to wait for the offer in compromise to be accepted by the Internal Revenue Service or any correspondence back from them. And you're going to keep up with, or your taxpayer is going to keep up with their tax compliance measures, right? If you are sending some money, if your offer did calculate several $100s or several $1,000s, that's where you're going to go ahead and you're going to act as if the offer was accepted by making sure that your client stays on track with this, because this can affect them even accepting your offer, right? So like, let's just say you submitted this, and then on the third month or even the 6th month, they finally reviewed it, and your client hasn't been making any of the payments that they said that they would based on their offer. This can hurt your offer acceptance. So you do whatever you send in, you just want to say, hey, client, let's, abide by these terms that we're sending in until the IRS either accepts it or they decline it, either or. Type a 1 in the chat if you guys are picking this up, if that's making sense, because I want to make sure that you guys got that. Okay. If it's okay to type 2, and just let me know if you need any clarification on that part. All right. Perfect, perfect, perfect. um, so let me scroll all the way up, because I think, Barry, you had a question that I saw earlier. I think you were saying what was John's offer? His offer was, well, what do we say for John, guys? He was the one that was laid off from Fidelity. He was laid off. So we said that based upon his facts, he was a CNC, a currently not collectible. Currently not collectible for John. Claudius says, what happens if Ethel does not want to set an OIC to the IRS? She has nothing to lose. Okay, so you're talking about Ethel, our 72-year-old lady. If she doesn't want to do an OIC, listen. So if she doesn't want to do an OIC, she doesn't have anything to lose. Okay, I could see that. She doesn't have any assets or anything like that. You just never know. I don't know. Like, you just never know as far as I'm thinking, like, is there any possibility that she might inherit something? I don't know, that could be levied or seizured by the Internal Revenue Service. But you're right. There are taxpayers every year. I don't know the number. I can imagine that it's thousands of them, if not, I will say thousands. I can imagine that it's thousands of people every single year that pass that owe the Internal Revenue Service money that the IRS never is able to collect on. I can imagine that is realistic to think. So if you have somebody like Ethel that has nothing to lose, she doesn't have any assets, she doesn't have any heirs that you have to worry about, then sure, yeah, sure. But, if you can help her out on offering compromise and, and officially get that tax debt wiped out, that could still be a better option for her. Andrew says, will the test questions be foreign specific? The test questions will expect you to know foreign specific on 2848, foreign specific on 8821. And then when we get to the individual and business side, yes, you need to know certain forms specific there as well. They rarely would ask you, though, like you would rarely see a question where it says which form is to file an installment agreement, right? Like there's rarely like direct questions like that, but you still need to know the form numbers for like an installment agreement, for example. Or, like I said, the 8821, the 2848, you need to remember these numbers and who and what they apply for, who they apply to and what they apply for. So with regards to the debt for your descendants, the only time where that would be the case is if you have an estate. So, let's say Ethel passes and she has an estate. The IRS can and should be paid out of the estate of Ethel, yes. But going back to, I don't know if Claudia, if you asked that other question, yeah, going back to that, she has nothing to lose. Well, she doesn't have any estate. There's no other assets that the IRS is going to be able to get or recuperate their money from. But the way that it does pass on to the descendants is if Ethel dies, Ethel has an estate, and now her granddaughter is over the estate. Her granddaughter has a fiduciary responsibility to pay the Internal Revenue Service from Ethel's estate. And if she doesn't, the granddaughter can face um, civil and possibly even criminal activities if she doesn't properly settle. She could be held personally responsible. Let's put it that way. She can be held personally responsible if she was the fiduciary or the executor or the administrator over her grandmother's estate and did not settle the tax debt with the Internal Revenue Service when there was assets or income to settle the tax debt with the Internal Revenue Service. The IRS says, in fact, we are first in line to be paid from an estate. They want first dibs. So that would be a case where descendants would be responsible, or the fiduciary of the estate would be responsible. Karina says, are businesses versus individuals solvency evaluated differently? They're evaluated very similarly, right? So for a business, they're going to look at your income, your assets, and your expenses. And for your individual side, they're going to look at the exact same thing. So I wouldn't say there's any difference on how they are evaluated. On the business side, of course, it's going to be a little bit more complex because now you have other types of assets, right? You have accounts receivable assets, you have inventory assets, right? So the IRS is going to want to see all types of assets from your business to see, can you liquidate any of them to pay your tax debt? Digna says, what about our fees to do this process? That's a really great question, Digna. So how much should you charge for an offer in compromise? Well, it's difficult on some instances because you're dealing with people that doesn't have an ability to pay. But I tell my clients in Orlando, I said, listen, don't count people's pocketbooks. You don't never want to count people's pocketbooks. You never want to price your services based upon what you think they can afford. Because let me tell you, I've been gravely disappointed by charging a certain fee, a low fee for services, only to find out that they go somewhere else and they give that person thousands of dollars. Like, ma'am, where did you get that money from? Right? It's like you just can't count people's pockets. People are very strategic with and just from my experience, they're very strategic with the sources in which they can access money. You never know how people can access getting money, right? There's credit cards, there's family, they might have a secret safe deposit box, which is illegal to keep money in a safe deposit box, by the way, but you just never know. So going back to the question at hand, how much you should charge, most people charge a minimum of $1,500 for an offer in compromise. And that's low in comparison to how much the tax resolution industry charges. But in most times it's fair, right? The paperwork is extensive. Like if you see that form, it takes, like if we go back to like that 656, listen, they're asking for everything. They're asking pretty much everything except their blood type on this form, right? You have all this personal information, assets information. Now, this is easier, obviously, when the person doesn't have as much assets. It's going to be a lot easier to go through, but you got to factor in, it's going to take you at minimum, I would say between 8 and 10 hours total time to assist a client with this process. 8 and 10 hours initially just to get the package together, collect all of the substantiation, the source documents, and then IRS wants you to neatly compile the offer in compromise. Like you should, like, remember, they're going to be asking you for bank statements and, mortgage statements and all that other good stuff. So you want to make sure that you have like sticky notes labeling like this is wage number one, W-2 number two, right? You want to make sure it's so organized. So when the IRS agent gets it, they easily see what's what. They don't have to be flipping through trying to find stuff. So it generally takes several hours to compile this paperwork. It's going to take your client several hours to compile on their side. So about $1,000 to $1,500 is fair to just do this when you're just starting out. As you get more experience and you really start to help people, primarily businesses now on this side, that's when you get into charging, several $1,000s for this entire tax resolution, the offer in compromise process, right? It could be easily minimum $5,000 for this. And then think of it as payment arrangements, right? Oftentimes they're not paying the total amount up front. So $5,000, if you put them on like a 6-month payment plan, that's about $833 a month. And they'll pay that off. For most businesses that owe tens of thousands of dollars in tax debt, that's comfortable for them, right? And then it allows you to prepare their offer, to make timely follow-ups on the offer, because you do. I always like to reference this saying with regards to the IRS. It's called the squeaky wheel gets the oil, right? You guys heard of that? The squeaky wheel gets the oil. What that means is the person that's complaining or making the most noise, those people tend to get serviced faster, right? I saw this at Burger King the other day. I was in the airport coming back from Orlando, and they had the longest line, and me and my kids wanted to get some like French toast sticks or whatever. And before our flight, we were a little hungry. And so we're waiting, and people are getting frustrated because we got to catch our flights now. It's been 20, 30 minutes. We still waiting on some French toast sticks and some coffee. And so the lady goes up there with her receipt. She's like, "Where is my number? Like, I need this. I gotta go." Her number was after mine, right? She came like 3 people after me. But because the squeaky wheel gets the oil, she got up there and she squeaked. They gave her stuff right away. And I was like, okay, now I got to squeak because my flight was starting to board. But the squeaky wheel does get the oil. So the person that's going to speak up is normally going to be the person that gets help faster. So the same is true with the Internal Revenue Service. You sometimes have to make follow-ups with them to say, hey, I submitted over this OIC, haven't heard anything. What's going on? Hey, it's been 30 days, it's been 60 days, it's been 90 days, it's been 6 months. What's going on? What do you need? What other substantiation do you need? What documents do you need? The squeaky wheel gets the oil. So remember that with Internal Revenue Service. Sometimes you can't just let them rest on their laurels. And especially when it comes with like, this really applies to people that are getting so much information in my brain. When people are changing their entity. Okay, here we go. So let's say you help your clients go from a Schedule C to an S corporation, for example. You're going to fill out a specific form that you're going to learn when we get to the business side. It's 2553. When you submit that to the Internal Revenue Service, they have their processing time, right? But because the IRS is handling 200 million pieces of paper a year, right? They get bogged down, right? Your paperwork gets lost in the sauce. Like I've had clients where their business client their paperwork never got processed. And now it's the next year and they're trying to file the S corporation return, the 1120S, and it gets rejected. It gets rejected because the IRS saying, we don't have this EIN, this business as an S corp. No, they're still a disregarded entity. So it gets rejected. So again, like little stuff like that, you got to remember the squeaky wheel gets the oil. If you submit a 2553 to change an entity to an S corp, you should follow up on that at a regular cadence. I would say at minimum every 30 days until that S corp is processed, until your client receives confirmation paperwork. So this is just an example that I give you guys with how you need to deal with Internal Revenue Service. Interest does accrue while you're waiting for OIC. Yep. or when you're on a CNC. I'm just making sure I didn't see any other questions. Okay, so I think I got that question, Karina. Are businesses versus individual solvency evaluated differently? It's very similar, so that they're going to value their income, their expenses, their assets the same. Like I said, it's some nuances obviously with the business. They might have, more debt. They might have inventory. They might have accounts receivable. How often do you have repeat clients with tax resolution? Well, I would say this, if you are truly educating your clients on how to stay compliant. So, for example, whatever got them into owing the Internal Revenue Service in the beginning, you want to make sure that that doesn't happen again. Obviously, you can't control your clients. You don't have control over their finances, but you want to make sure to say, hey, well, what got you into trouble before, Mr. and Mrs. Business Owner, was that you weren't paying estimated taxes, right? You grew really fast during COVID. You guys made $1 million plus with your e-commerce store, but you were not paying any estimated taxes. You got hit with this big tax bill at the end of the year, and you've been doing that for the past couple of years now. Okay, you need to start paying estimated taxes. Here's how much our fee is to help you do this on a quarterly basis. And you need to educate your clients, right? So I would say oftentimes you can turn your tax resolution clients into monthly or even quarterly tax compliance clients if you educate them and let them know how you can help them. And that's a really great way to obviously increase your revenue in your firm too. Kevin says, what if they deny the offer? Yeah, so the IRS can deny the offer if they see that your client has the ability to pay them. They're going to look at the assets, they're going to look at the ability to pay, the income, they're going to look at their allowable living expenses. And if that calculation is not calculating, they're like, we think we can get our money from you on an installment agreement. So here's what we approve. We'll approve you for an installment agreement at X amount of dollars per month, right? You can appeal, though. You can appeal any decision that the IRS renders you. Obviously, the negative decision that the IRS renders you. If you appeal, though, you have to make sure that you are appealing on a basis that is not going to get you the same results. Like it has to be something else. So you'd be like, oh wait, but we're sorry, we forgot to include in these expenses, right? She actually has these expenses. If you're going to appeal, you need to make sure that you're coming with some sort of substantiation. So if they deny it, you do have options to appeal. You just want to make sure that that appeal would be substantiated with either new information or maybe the IRS. They're human, those folks behind the IRS, they're human. They might have misinterpreted some data that you sent over. Then you would say, hey, no, you got this wrong. This is actually this. And then you can appeal that way. But it needs to be some sort of valid reason. If not, you would just help your clients go to the next, to the option that the IRS is recommending, which is generally going to be an installment agreement oftentimes. Barry said you had a question about the book. Any individual may represent an individual or entity who is outside the U.S. before personnel of the IRS when such representation also occurs outside the U.S. What does this mean when such representation also occurs outside of the U.S.? Yeah, so what that would generally mean is normally in the context that I've had experience in is where you have a client that is currently outside of the US and they don't have any, they haven't been on US soil for more than 60 days. You can they can have somebody in their stead represent them before the Internal Revenue Service, take over power of attorney with regards to their federal tax matter if they are not in the country. Your other part to that was, what does this mean when such representation also occurs outside the US? So I would say the verbiage is really just towards that, right? It's really just if your client is in another country, oftentimes that happens when you have people in military, they're not here, and they need support with their tax obligations. A lot of military folks that are deployed, they have power of attorneys or representation. They also have automatic extensions that they qualify for that we'll discuss more on the individual side. But that's really what I would say the impetus of what that's saying is that if your client is outside of the country, they can have somebody, an individual or an entity represent them when they are overseas. Margie says, what about if they don't accept the case? You said, what if they don't accept the case? What do you mean by that, Margie? Okay, so when you say follow up, do you mean calling that practitioner number every 30 days? Yes, Crystal. So you're going to call the tax practitioner priority line, or you'll call the number of there's certain departments depending on the type of client that you're working with. So if you're working with a business client and their tax debt is already in collections, generally you're going to have that number on their IRS notice that you're going to call. So you can call those numbers, those hook you up directly to that department. If you don't have a direct number that's on a notice, then yes, you will call the taxpayer priority line. Oh, Margie says, okay, yes. Thank you for providing more context, Margie. So she says, yes, the case where they have the 20% in installments, they pay the installments, but they don't accept the case. Okay, got you. So what they're going to do is they're going to just apply that tax, those tax payments to your client's tax debt. So whatever your client did pay is just going to be applied to their tax debt. And whatever decision they render, like if they deny it, of course, you have your appeal process that you can go through. But if not, then your client would just get on an installment agreement with the Internal Revenue Service, and then you can help them, factor how much that is and work with the Internal Revenue Service if they can afford that amount. The amount generally that's divided by 72 months. You can work with Internal Revenue Service to get, an exception to that amount to get it lowered. But yeah, if they already paid, but the IRS didn't accept it, that amount that they pay just goes to their tax debt. Yeah. All right. Great questions, guys. Great questions. So let's keep it moving with our next part. We need to talk about levy, lien, and seizure. Okay. So you guys know how I told you the IRS has how long generally to collect? What's the CSED period? The CSED period for the Internal Revenue Service. What is that period that they have to collect their tax debt from taxpayers? 10 years. Yes, 10 years. So what happens is we talked about certain actions might extend the CSED period, right? So like going after that offer in compromise, being on a currently not collectible. Anytime you pause collections, that you are agreeing to the CSED being extended by the time period that they pause collections for, right? And they generally have 10 years. Now, in the eyes of the IRS, this is it's 10 years can go by fast. Let's just say that. Like you think, wait, COVID was 2020. We're already about to be in 2024. I'm still trying to get off my COVID weight. Okay. Like I'm still on a struggle bus with that. I'm like, dang, I feel like we just came out of that and it's about to be year 4, right? That we're going on. So 10 years goes by slow, but it goes by fast as well. So with regards to that, the IRS, they can use their full tax collection strategies or tactics to collect as much tax debt as possible. Like the IRS is the main tax collector in the United States, where there are only federal tax collector, right? But what I mean by that is you got to think about collection companies. They're the largest collection company in the United States. So they're going to deploy all available resources to collect their tax debt. So a lien, the first thing that your clients is generally going to experience is a lien. This happens when they don't respond to the Internal Revenue Service, they're ignoring them. They owe the Internal Revenue Service either by way of an examination or taxes that they filed that had a tax debt due on it. The IRS is, after they propose the notice of how much, or a notice of tax deficiency, after they send that, right, which is your 90-day letter, we'll talk about that in just a second, and your client is unresponsive, the first strategy or the first tactic that the Internal Revenue Service is going to do is put a lien on your client's assets. So if your client owns any assets, they're going to put an interest on it, right? So this is them saying, hey, okay, we see you have a house. We see you own real estate. Well, we're going to put a lien on your assets so that if you try to sell your assets, or when you try to sell your assets, we are the first person in line to be paid from any equity from your assets. So your lien is really saying, or the IRS saying, that they have an interest in your asset, right? So that's step one. Step two, they'll do a levy. If your client still hasn't worked out any tax resolution options with them, they're not on an installment agreement, they're not on CNC, they're not applying for OIC, they're just ignoring the Internal Revenue Service. The IRS is going to be like, okay, we need to step it up a notch. We're going to put a levy on your assets. This is where what I say, they take the shirt off your back. Literally, they're going to swipe your bank account. They're going to swipe your paycheck. They're going to swipe your pension. This is where they're going to garnish your wages. This is generally what gets people's attention, unfortunately. When the IRS and you pull up your Bank of America account and you see you had a direct deposit go in your account, but now you only got $20 left or $0 left. Oftentimes they take you down to $0. They take all of it. Providing that, obviously, if all of it still didn't satisfy your tax debt, right? That wakes people up. That's when they want to get some help, and they get scared. So this is where a lot of clients is going to start coming to you when they first get this lien. This is going to be where a lot of people are going to be like, oh man, I'm desperate. I need to get this situated. They really come to you when they get garnished bank account or paycheck. Now, the last resort, this is absolutely the last resort. The IRS is not in the business of taking people's, having deploying the seizure of actual assets of taxpayers. This is for egregious taxpayers. Now, mind you, the IRS is going to notify your client before they do any of this, right? They're going to send them a notice of federal tax lien before they actually file the tax lien. They're going to send your clients a notice of garnishment. So your clients would generally know, or would have had some sort of notice before these actions happened. Oftentimes what happens is your clients don't open up the mail from the IRS because they're too scared, or they're too overwhelmed. Listen, it's an overwhelming issue to deal with the Internal Revenue Service with back taxes. Or they don't properly understand the notice, so they might have missed some of the important verbiage that is in these notices. So they will send a notice of seizure to give your clients time to satisfy their outstanding tax debt. If they still don't respond or make arrangements, that's when the IRS is going to take the physical asset. They take the car, the business equipment, the business, the real estate. This is the last resort. You have to be either owing a lot of money to the Internal Revenue Service, and a lot is subjective. um, and or be in tax debt for a long time without any resolution option. One of my clients was about to go through a seizure. Well, the IRS agent threatened a seizure. So what happened was, she came to me, they were trying to do their payroll taxes themselves for a long time. And they finally come to me for bookkeeping, to get caught up with their taxes. And I'm like, whoa, like these people owe a lot of money. They owe the Internal Revenue Service tens of thousands of dollars. And what happened was she was trying to first negotiate. She was like, "Can I wipe off my tax debt? Can I eliminate this payroll tax debt?" It was trust fund taxes. Now, what are trust fund taxes? Is actually part of my lesson. We can talk about it now. Trust fund taxes is as a payroll employer, as an employer, when you are running payroll, you are withholding FICA taxes, right? You're withholding federal, Social Security, Medicare, oftentimes state and local taxes from your employees' paychecks. Well, as an employer, we have, if you're an employer, your taxpayers are an employer, have a fiduciary responsibility to remit the taxes that we withhold from employees' paychecks to the Internal Revenue Service, right? That's why they call it trust fund, because we are in trust of these funds to be remitted to the Internal Revenue Service, right? Well, I didn't know this at the time, but the IRS does not offer in compromise on trust fund taxes. If these were payments that were withheld from employees that you were supposed to remit over, they do not let you offer and compromise this out. So when I was talking to the agent, she was telling me this. She was like, "Nope, we don't do that for trust fund taxes." She said that if your client doesn't get on some sort of resolution with me, if she can't make the monthly payments, I'm going to shut her business down. And at the time, I thought it was pretty harsh. I was like, well, how you gonna get your money if you shut her business down? Again, guys, I was 23, 24, 25 years old when I first started as an EA. Like I was winging it. Okay. Let me tell you, Jesus, I was winging it. And so it still freaked me out. I was like, I've never heard a agent talk like that before. Like, I'm just going to close her down and dissolve the business and take any of the assets that she has then from the dissolution of the business. But this was the absolutely last resort that the agent would have done if we didn't work out a tax resolution option, right? Which was we got on the payment plan. We filed all of her taxes. We filed all of her payroll taxes, and she paid X amount of dollars per month. This is the last resort. And mind you, this client was also in tax debt for several years, 10 plus years before we got to this, the IRS agent threatening a seizure, closing the business down. So again, trust fund taxes, Mary got paid $1,000. The employer withheld $200. She was supposed to remit that over to the Internal Revenue Service. The person that's responsible for the remittance of trust fund taxes can be penalized. So if you're doing payroll for your business owners and you're the person responsible to remit this over the trust fund taxes to the IRS, they can hold you personally responsible for this. And the trust fund penalty is 100% of the tax debt owed. And oftentimes it's several $1,000s tax debt owed. The penalty will be equivalent to that. And they can hold you personally responsible, just so you know, FYI. So you always want to have some separation of powers if you're doing bookkeeping. When I was going through, years ago, when I was going through my bookkeeping certification process, they had recommended that you don't have signing authority if you really didn't need it. You never really want to be the person that's signing the checks or signing, or when you sign the checks, you're saying you have authority to make sure that somebody is paid. The more responsibilities you have, the more liability that you are exposing yourself to. So you just want to be careful with that. And just make sure that, if you are signing checks, that there's safeguards in place to make sure that you are paying everyone who is due on time, especially the Internal Revenue Service and states as well. Okay. So moving on to abatement of penalties, you can help your clients abate their penalties. So what that means is you can, in essence, help them waive. You can help them get their penalties waived. Now, these are the types of penalties that you want to understand. So there's a failure to file penalty. So this penalty is imposed when a taxpayer fails to file their tax return by the due date. There's a failure to pay penalty. This is a penalty imposed when they fail to pay the tax liability by the due date. I used to think that when you filed an extension for a client, that extension was for an extension to pay, right? I mistakenly thought that when I was younger. So what's the extension form? Anybody know that off the top of their head? Because I know I have some people that's been in business for 20 plus years in here, right? It's so impressive. So let's see, an extension, IRS, what form is that? That is form, is it 7004, Digna? Thank you for popping that in here. Let's see. Yep, 7004. Yep, thank you guys. So here is the form. Oh, wait, hold on. That's for, okay, yeah, this is for business. Okay. So we have the application for automatic extension to file for certain business income tax. Yeah. So let's also pull up the individual one. So Digna says 4868. So let's see. Here we go. So this is for the individual application, right? 4868. So what I thought when I was a new and young enroll agent, I thought if I filled this out that it gave them extension for everything. It gave like if they owe several $1,000s, it gave them extension to pay that too. I did not realize until years later, and I'm embarrassed to mention that, but listen, I'm being transparent with you guys so you don't make the same mistakes I made. I didn't realize until years later that this was just an extension to file the return, right? Extension of time to file U.S. individual income tax return. So that means that they don't have to file by the due date. Once they file this extension, they generally get 6 months, right? A 6-month extension. So for individuals, this is going to be due October 15th, right? Their normal due date is April 15th. The extension is generally going to be October 15th. Similar to your application for extension for businesses. Now, businesses have different due dates, right? We'll get to that when we get to the business side, but this will be 6 months from the specific due date for businesses, right? Now, that's that. So these are your extension to file. Now, there is an extension to pay. There's an extension to pay, but however, the IRS says you can't get this unless you are going through an absolute hardship. You cannot get this. They are not going to give you an extension to pay unless you can prove that you are going through a hardship. Where is that format? Where is the extension to pay at? Here we go. Extension of time for payment. So this one is for business. Right here, 1138. Extension of time for payment of taxes by a corporation. Expecting the net operating carry loss back. So this is for the NOL carry back. But there are certain extenuating circumstances. Like even if we look at this one, right? It says, give the reasons, facts, and circumstances that cause the corporation to expect the NOL. They also going to want to see the reason, facts, and circumstances that you need an extension to pay. Can anybody, let's see if we can find it together. It's called an extension of time to pay. I don't know why it's not coming up when I Google it. Extension of time to pay, IRS. Okay. I'm not going to waste any more time. I'm going to find it on our break unless somebody finds it before me. Oh, here we go. Yes. All right, it's 1127. Here we go. This is the application for extension of time for payment of tax due to undue hardship, right? So just so you guys know, your any of your clients can file an extension to file, right? Businesses as well as individuals can file this extension to file. But the IRS will, under hardship circumstances, give them an extension to pay their taxes due, but you got to come with a really good reason. You got to really establish the hardship, undue hardship. So what they say is undue hardship can be financial loss if forced to pay a tax or deficiency on the due date. And then they give you a little bit more information back here in the instructions on kind of like that undue hardship or reasons that you could potentially use. But generally you could think about, extenuating circumstances like I guess acts of God, there's sickness, things like that that might prevent or cause undue hardship to your clients if they pay this taxes on the due date. This is rare, not everybody is going to go this route. Okay. All right. So these are all your penalties. Now, again, if you look at all of this, failure to file penalty, failure to pay penalty, accuracy related penalties, late payment penalties, listen, by the time your clients get their tax bill, you can imagine that, if they originally owe 5,000, they might owe 15,000 because you're going to have all of these penalties plus interest that is going to accrue on that balance, right? Now, you can help your clients get these penalties abated with and under certain circumstances. So you have a reasonable cause abatement. This is if the taxpayers can show that their failure to comply with their tax obligations was due to circumstances beyond their control. Again, this is natural disasters, serious illness, death in the family, or unavoidable absence, something like military, you're out of the country. Number 2, statutory exceptions. This is certain penalties have statutory exceptions that provide relief under specific circumstances. So, for instance, the IRS may abate penalties related to the failure to timely deposit employment taxes if the taxpayer meets specific criteria outlined in the tax code. You do have your first time penalty abatement. So, this is the one that the majority of your clients can apply for. So, a quick win that you can get your clients is getting them the FTA, which is their first time penalty abatement. This is for people that have complied with their tax history for the past 3 years, right? So they would have needed to have filed all their tax returns on time over the past 3 years. And it is available for various penalties, including the failure to file, failure to pay, and failure to deposit penalties. Let's look at a tax due notice really quick. Tax due notice example, IRS. So I want to show you in case you haven't seen what it looks like. So this one is a notice of intent to levy, total amount due 4,000. And then they'll break it down like this, right? So you have your failure to file penalties, you have all your interest, and then a total amount owed. And this is how they're getting to the 4,800. But we see here, $400 is just in penalties. Oftentimes your clients look way worse than this, right? It's much higher than this number. But even right here, if you get them a FTA, the first time penalty abatement, they can get this $400 wiped out. Now, the IRS did release some guidance, I think it was about a year or so ago, that they were going to automatically waive certain taxpayers' penalties from certain tax years. I believe it was from like 2021 or 2022, 2021 and 2022. I think during the COVID era, right? So between 2020 and I believe 2022, they were automatically going to waive any penalties that were assessed to taxpayers that had balances, which was beautiful because that amounted to thousands of dollars for most taxpayers in reducing their tax debt. To check this, though, you just want to make sure that you pull your taxpayers' transcripts to see, how much or you have them pull up their tax account to see all of this. That's the easiest way. And then you could pull up their tax transcripts as well. But you want to see, were they a part of that kind of like automatic penalty waiver? If not, you can help them get their penalties abated. And this is a quick win that you can get your clients. Some basis for penalty being abated can be an error, right? So if the IRS made a mistake, if there's an unreasonable delay by the IRS, if there was erroneous written advice that the taxpayer relied upon, a tax court or legal settlement. So these are just some other bases for having your interest abated or refunded. Now, the way to request this, the most easiest way is to call over the phone, and you can actually do a verbal request for a first-time penalty abatement. You can also do a formal written request. That's generally going to be on Form 843. So you would do a claim for refund and request for abatement, and you'll fill this out on your client's behalf and submit it over to the Internal Revenue Service. All right, what questions do you guys have about this part before we move on to our final part of the evening? Claudine says, what happens if you don't file by October? That's where you're going to get the failure to file penalty, right? So you're going to have an extra penalty that your clients incur when they don't file on time, even if they don't file their extension on time. Kevin said, you heard we can't get a first-time penalty abatement unless they are on some sort of repayment plan. And you know what, Kevin, I would say that's generally the case because a part of one of the stipulations for the first-time penalty abatement is one, they want to see that you're compliant, right? So if your client just has tax debt sitting there and they're not on some sort of payment plan, the IRS is like, okay, well, we need to get you compliant. And compliant means that you are actively working towards handling your tax debt. So yes, that would be a fair thing to say, is that your client, you wouldn't just ask for a penalty abatement and your client, it just has a tax debt sitting on the IRS's books. You're generally going to ask for that, a penalty abatement, when your client is compliant with their tax filing obligations and they're on some sort of payment arrangement with Internal Revenue Service to show that good faith that they are trying to stay compliant with their account. Yeah, thank you for mentioning that, Kevin. Karina says, are there tax accounts for individuals like there are for businesses? Are there tax accounts for businesses like there are for individuals? Yes. So business is a little bit different. You're going to be on the EFTPS side, but like if we go to the irs.gov, and I'll share my screen in just a second, you have, let's see. Okay, so if we go to the irs.gov, they have both here. So you have your individual tax account, and then you could sign into your business tax account. Both of these are going to like help your client access all of their tax information. Even on the individual side. So for example, if your client, let's say they're on the payment plan and they're like, oh man, these payments are becoming kind of tight for me right now. They can sign into their online tax account, and oftentimes the IRS allows them to amend their installment agreement right then and there and lower the amount. So there's a lot taxpayers can do within their tax account. Obviously, they can pay on their account. In their tax accounts, it gives you a breakdown of how much the taxpayer owes and for what tax years. You can even see past notices that the IRS sent the taxpayer oftentimes you can see that in the tax account as well. So the tax account would be a perfect stop for your clients to keep up with their um, payment plans and other obligations that they might have. Maria says, if you are the payroll processor for a client and the client doesn't want to pay the payroll liabilities, EA as third party is responsible for those payments. Only if you are the responsible person to remit over those payments, then yes. But there's ways to protect yourself. So, for example, to your point, if you say, hey, Mr. Business Owner, you have to submit over $2,000 this week for your federal tax deposits, right? For your payroll deposits. And they're like, sorry, don't have it. We spent it on something else. Well, you're going to document that. And you're going to let them know, well, listen, these are trust fund taxes. You need to make sure that you pay these on time. The IRS does incur penalties, but you can't, it's their business, right? So if they say no, you can't, go in there and take the money out anyway. But you do want to protect yourself to show, hey, I wasn't responsible. I couldn't just take the money out of the client's account, but I did tell them of their tax liability or their tax compliance requirements. And they said that they couldn't or didn't want to handle it at the time. So you just want to make sure that when you're doing payroll and just across the board, that you are covering yourself, right? You're making sure that you're documenting your conversations, you're recording calls. You are, if you have a call with somebody like this on Zoom or over the phone, you always follow that up with the email to say, hey, Maria, it was really great talking to you. Here's a summary of our call conversation. I told you about your federal tax deposit obligations. You informed us that you couldn't make the payment right now. We informed you about possible penalties and interest that would accrue if you didn't submit these deposits on time. And you told us that you will follow up in the next 7 to 14 days, right? The whole point is I am covering my phone conversation with a written correspondence. So if there's ever a dispute, if I'm ever audited, or if there's ever a question on who is responsible, I can always go back and refer to my notes and refer back to our email thread conversation. Margie says, do you have a list of fees for all these forms? How much you should charge? Not for these forms specifically, or maybe we do. I'll double check that, Margie. I think we do have a list of a lot of these forms. Jolie says, can you request abatement of penalties when you already are on an installment agreement? Yes. Yes, Jolie. And in fact, that is the perfect time to request abatement of penalties when your clients are on an installment agreement and they have been compliant with their tax filings and compliant with making those installment payments on time. That's the perfect time to ask the IRS to say, hey, can you waive these? Yep. So the quickest way to file Form 843, oftentimes you can get a lot done over the phone. It's the quickest way. You're over the phone. You can fax it over to them. They'll ask you some questions. That's providing if you have 2848, right? If you are their representative, you can do that. If not, if you're not 2848, their POA, then you generally would go ahead and submit that over via mail and just make follow-ups. Have the client, you guys could kind of do that in conjunction to make follow-ups. But assuming that all you guys are going to become EAs, you're just going to call on their behalf and already have that authorization to advocate on their behalf, right? Because penalty abatements is a part of tax resolution. That is definitely a part of your tax resolution services. Yep, same with an extension. So the extension, you're normally going to file that, and you can file that with the tax return. So if you haven't done that yet, so for example, next year, 2024, let's say it's April 2nd, and you want to file an extension for your client, you can go in your tax software, you can pull up the extension form, which we said was what, 4868. It was 4868. You can pull that form up in your tax software, fill it out, and e-file that. And that's it. That's all you got to do. And that's how you would get the extension file. Karina says, how does that work with ID me for the business account? So to my understanding, that's still going to be based on the principal officer. So they're still going to verify the principal officer, and then they'll verify the business EIN, and that's how you would get access to your business tax account. Let's go on there and see. So, yep. So, they say, how do you verify my account? So, yeah, they're going to verify you as a principal owner, just as they would on the individual side. So, they're going to take a picture of you. You're going to hold up your ID. You're going to answer some of your identifying questions, and then you're going to add on your business information, and that's how they substantiate you. Very similar. Oh, Crystal says I have a free masterclass on pricing on certifiable. Yes. I just can't remember if we include these forms in that pricing category. I don't know if we include like 2848, 8821, 9848. I don't know if we include, I'll double check though, if we include like all of these forms that we've been talking about. I'll double check to see if we got those on there. Will you be able to send us a roundabout the ballpark of what we should charge as the EA for different services? Yeah, and you know what? And that's kind of how I've been doing this training too, kind of giving you guys like, you charge a $500 discovery fee. But yeah, I think towards the end of this class, we definitely can spend like 20 minutes just going over specific fees. Like, and this is just suggested fees, guys. Everybody has to find the sweet spot for them. But I would definitely more than happy to go over like suggested fees for what you should charge for a lot of these services. Ashley says, will you do an update? Yes. Yes, Ashley. We definitely would do an update. Probably sometime in November. We should get that updated. Oh, Crystal said 2848 is on there. Okay. That's good to know. All right, guys. So let's go ahead and take our break before we move into this final session. We have about it's 5:50, it's 5:13 my time. So let's go ahead and come back. We'll come back at we'll just do a quick 10-minute break. Was that 5:23? So what's that? 5, 6, that's 8:23 your time. So come back 8:23 Eastern Standard Time, 5:23 my time, or 7:23 if you're in the central area. And I'll see you guys back in 10 minutes. You guys are my people because you're going to keep me together. Thank you, Athena, because I was sure enough about to just keep going. All right, guys. So to round out this session for tonight, we're going to just finish up with the IRS examination process and how your taxpayers can actually get to tax court. Okay. So there are specific steps that you want to consider when your clients are being audited. Now, there's different types of audits, and you're going to hear me use these words interchangeably. Like I might say audit or I might say examination. This is also how the IRS refers and how they might communicate as well. They might say audit or they might say examination, but it's really the same thing. So what happens is if your client is chosen for an audit, there is generally three types of audits. The most common one is what? Type in chat. What is the most common type of audit called? What is the most common type of audit called? Or examination, whichever one you want to use. Yeah, Janelle says correspondence. Yes, your correspondence examinations, they are going to be mailed to the taxpayer, and it's going to outline what the Internal Revenue Service wants them to substantiate. So they could say, we see that you claimed the earned income tax credit. We see that you had also claimed Schedule C, business income and expenses. And they might want to not only ask for substantiation of the children that they're claiming, but they might want to ask for a substantiation of the business income and expenses that was claimed on the tax return. So the majority of audits over, I don't know the exact amount, but I believe last time I checked, it was over 4 million audits are conducted just through the mail, correspondence. You do have the second type of audit where I was telling you guys, early on in this training, where you're actually working with a revenue agent. These are primarily for your business clients and for your high net worth individuals. You're going to be working with a dedicated revenue agent. And this is where I went to the IRS's office downtown Detroit, and I represented my client. I actually sat there at the IRS agent's desk. I provided her with all of the substantiation that she had requested. I had to reconstruct some of the the business taxpayers' information, right? They didn't have bookkeeping. I had to reconstruct some of their information, which is allowed. And I sat there and she flipped through all the correspondence and all of the substantiation that I had given her. She asked me a few questions. And I believe I was there for maybe about an hour and a half or so before I left. And she told me the next step. She was like, okay, also send me this, drop off this. And you're working directly with this person, right? You often have their direct telephone number, and you often have well, I've never emailed anybody. It was normally their direct telephone number, and you're gonna, drop off, submit any required substantiation that they need you to submit over. Now, the third most highest form of examinations is when the revenue agent comes to you, right? The revenue agent, one of the businesses that I was telling you about earlier, where she said that she threatened to shut the business down if the client didn't get, compliant. She actually popped up at my tax office. She walked in. I thought she was a regular client, and she told me that she was examining this business, and she was the agent assigned to the case, and she needed to review and talk to me because she see that I was the most recent power of attorney for this business, right? I had just recently filed a power of attorney, had just got on a case maybe a few months prior. I was just getting the client caught up with their bookkeeping. When she comes in there, she sits right across from me and she goes, pull up their QuickBooks file. And I'm nervous. I'm like, oh my God. So I pull up the QuickBooks file. I turn the computer towards her, and we're going through the profit and loss. We're going through the transactions, and I'm like sweating, like, holy crap. Right. She went to my client's home. Right. So this is the highest, these are called field audits, right? Where they actually get in their car and they are go knocking on people's doors, right? Again, these are for your high net worth business owners, your high net worth individual taxpayers. There's very few of these happening. There's only several hundred field auditors in comparison to the tens of thousands of IRS agents across the country. So you just have to understand it does happen, but it's for the most, highest of high tax situations. So she went to my business owner's home. She left her card. She called me on her cell phone. Like, I had this lady's her business cell phone number, her employer cell phone. And she's like, I want you to call me every time she pays her payroll taxes on time and she makes her installment agreement. Like, I had to call her and say, hey, we just submitted our the payroll forms or the payroll taxes. Like, that's the level of oversight she had with us for a couple of weeks, because she wanted us to make sure that we stay compliant, right? This was also the lady that was like, she eventually threatened, like, she can't offer and compromise her tax debt, or her trust fund taxes more specifically. This is also a situation where, here's another thing, where the client she tried to do a quit claim deed of this property that she had in her name or in the business's name. She tried to quit claim deed that to one of her children. And the IRS agent caught it, and she called me up. Like, it was like maybe the next week, the IRS agent calls me up, and she's like, yeah, I saw where she just tried to do a quick claim deed. She's like, I saw that. I see that. And I was like, oh, okay. And she's like, and I think actually that's when she threatened to close the business out. She was like, listen, if she don't get it together, like that. So what I want you guys to know is the IRS has access to third-party data, right? You guys need to know this. And so it is really incumbent upon you to inform your clients that they should not lie to you or try to manipulate ownership of assets, right? The IRS sees this. They have access to many third-party data sources. Type in chat, what third-party data sources do you think the IRS has access to? We already know they have access to county records, right? They can pull up county records, and that's how she saw that quick claim deed. They have access to bank accounts. Yes, bank records. They can request and do a sweep. One of the clients, Tiffany, she was letting us know because she used to work in banking that oftentimes they'll do a sweep of all of the top banks in an area where your client resides, and they'll ask the banking institutions to report on any accounts that the client might have, right? So they'll do a sweep. Clarice LexisNexis. Barry says state Fed bank electronic transfer. Sharon says credit profiles. Yes. Brittany says employer and online apps where money is moved. Rakosa, Social Security. Yes. Credit reports. Yeah, they have access to so many third-party data sources. They have authority to submit records requests to all of these third-party data sources. There's something called, and I might get it slightly wrong, but it's something called the John Doe. Is it a John Doe summons or the John Doe subpoena? It's something to the effect where the Internal Revenue Service has this John Doe kind of like authority where they can summon the records to financial institutions of any taxpayer that has a certain amount of money over, generally it's $10,000 in foreign bank accounts, right? So they have subpoena powers where they say, hey, we don't even know who might be hiding their assets in your bank or in your country. But because we have summons powers, we have John Doe summons powers, we want to do a sweep. We want you to send us a list of every client that has over this amount of money in your or at your institution, right? And somebody can Google that to get the exact terminology, but it's something to the effect of like John Doe authority, right? That they can sweep any bank account and ask for information, client information on who has certain amounts in certain financial institutions. So the IRS has all of this access, and it is not wise to try to manipulate, the information that you send to them. It's not wise to do that. Brittany says John Doe summons. Yes, thank you, Brittany. So when you're going through examination process, here are the most common steps. So first, your client definitely gets an initial notice, right? So the IRS will initiate the examination process by sending a notice to the taxpayer. This notice would specify the tax records or issues under review and provide instructions on how to proceed. Number two, this is where you have the initial meeting with the assigned IRS agent. The meeting will serve as an opportunity to discuss the scope, propose of examination, address any initial questions or concerns, and establish lines of communication. Number three, you have your information gathering phase. This is where your clients and you are going to assist them gather all of their tax returns, financial statements, receipts, invoices. This is also where a part of my job was to help them reconcile some of their receipts. Like one of the clients, she didn't have certain receipts or certain substantiation that we had to go back and reconstruct. And that is totally allowable as well. As long as you can substantiate it, you can help your clients reconstruct this information. I had to get her bookkeeping caught up, right? So a part of what they wanted to see was, a year-to-date profit and loss, a balance sheet, right? They want to see what type of assets the client has. So, and then also a big part of the bookkeeping is just helping them figure out how much in deductions did they truly have, right? Because the client that I was working with, for example, the IRS was trying to disallow a lot of the deductions unless she has substantiation for it. So a part of my job, which I did not charge enough for, was reconstructing her records and then getting her bookkeeping caught up, and actually found that she had way more legitimate deductions than what was actually reported. And the agent just actually wiped out her the proposed changes, right? They actually corrected it. And, after we had gone through the examination process, the client didn't owe anything after that, because I was able to help them substantiate their deductions. And we actually found even more deductions that they qualified for that she hadn't even filed the first time. So that's just an example of how this process goes. Now, sometimes you don't get a happy ending like that. Sometimes, uh, the proposed changes are your client owes, in which case you can accept the decision, you can accept the proposed changes, help your client get on an installment agreement, for example, or you can appeal the decision within the IRS, and you can also pursue any other avenues, right? You can, there's litigation that you can go up towards if you don't agree. So after the examination, you're going to get your 30-day letter, your revenue agent report. This is going to be the results, right? The findings of the examination and any proposed adjustments to the tax liability that your client has. So again, they have an opportunity to respond to that revenue report by agreeing or disagreeing with the findings of that revenue agent report. And of course, you want to make sure that if you disagree, that you are substantiating why you disagree, right? You just don't want to disagree because you don't like the results or your client doesn't like the results. Oftentimes, when you're trying to appeal to the IRS, or you disagree with a negative decision that they might have rendered, you have to have proof and backup and substantiation on why you believe that decision was wrong. Now, there are a lot of forms that your clients are going to, get if they're owing any tax debt. It's going to be a CP 2000 notice and correspondence audit. So when a client receives a CP 2000 notice or are subject to a correspondence audit from the IRS, it's important to interpret and analyze the notice or audit carefully. So we kind of, talked about that, but you have to really look at the notice and understand what the client or what the Internal Revenue Service is auditing. I talked to a client the other day, not even the other day, this was like actually a month or so ago, but she's an enrolled agent. And she said that a part of her services is just helping people analyze their CP 2000 notice. I was like, oh, that's pretty cool, right? Like, she charges like $100 or $150 just to tell people what the IRS is actually asking of them. So I never thought about that. I was like, you know what? That's actually legit, because they might not need your help all the way, but they might just need help understanding what their requirements are, understanding what the IRS is truly asking of them and kind of pointing them in the right direction. Now, $75, $150, yeah, that's cool. I would probably prefer to package that up into like an actual service offering. So let me show you guys really quick what I am talking about for this, right? So let me exit out of here. And this is just some bonus information for you guys right now. But so for example, her service is she tells you what and why the IRS is auditing you, right? So what I would do, and she's charging like $75 to like 100, let's just say $150 for this, right? What I would do to get this fee up, you got to package up your services, guys, right? So what I would do is you have to break down the benefits to them. So we'll say we'll analyze your CP 2000 notice. We will render an easy to understand, excuse my typos, breakdown of what is required to win the examination, aka substantiate, but your clients really don't. They're not gonna really. You want to use easy to understand words when you're talking to your clients. Will render an easy to understand breakdown of what is required to win the examination, and then you'll also provide step-by-step instructions on how to answer the examination. And then we'll also give you a follow-up process to ensure timely resolution. What else could we put in this offer? Right. And this is going to be called my audit support maximizer. Guys, after 5 p.m., I get a little loopy. Okay, maximizer. So I might get a little silly over here. Okay, so follow-up process to ensure timely resolution. What else could we do? We could probably provide them with some sort of email support, right? Optional. We can add that on. What else could we do to really help them out with this, right? So this will be our audit support maximizer. Now I go from just saying it's $75 to now it's $500, right? And now it actually looks like a true and bona fide service that is actually going to be really helpful. And we package it up, right? We deliver it in this way, right? Where we deliver it into a report. We don't just tell the client, oh, this is what it means. We actually send them a nice report on how they or what the IRS is auditing them and how they can actually win and substantiate this, right? We actually give them step-by-step instructions. Now, what's interesting is you do this one time, what happens? You have what's called a blueprint, right? A blueprint. Then now you can rinse and repeat this for all your other clients, right? Just with some minor tweaks to it. So this is how you get your fees up. You need to actually show the value that you're providing, and showing the value means you're breaking out every step of the service and how it's actually going to help them. Well, Rita says, well, what if they don't win? That's not your fault. You know, you're showing them what is required to win. They might not have the requirements to win. They might really be trying to claim somebody else's kids. Okay. I told you guys after 5 o'clock. Listen, they might not be able to substantiate that those children are theirs, or substantiate that business or that business income or expenses. Okay. So you just got to keep that in mind, but you're going to let them know how they can substantiate and win it. You're not guaranteeing it. That's the other thing. Of course, this is going to come with your engagement letter, where it's going to specify results not guaranteed, because you can't guarantee what they truly have as substantiation. Now, this would just be package 1. This is your audit support maximizer. Now, if we wanted to go to the next, I might just do a whole class on this stuff, right? So the next one could be, you got your audit support maximizer. The next step would be, it might be your audit. So I'm thinking about my client. I had to reconstruct all that lady's receipts. I had to reconstruct her invoices. I had to do her bookkeeping. So we call that maybe our audit elite package, where if a business client is coming to you and they're like, oh my God, I was not keeping receipts. Okay, you can reconstruct. We'll do a reconstruction. First, we'll do an analysis, and then we'll do a reconstruction implementation, right? Because it's one thing to like analyze, okay, well, what all do we need to reconstruct first? Okay, we need to reconstruct some receipts. We need to reconstruct the invoices. She was slacking on that. And then now we need to actually do the implementation of that, right? Which is actually doing the work, right? We might need to do a cleanup, bookkeeping. And I might even say that as, I might even call that a deduction analysis. And based upon that deduction analysis, okay, we'll review the bookkeeping file, right? And based upon the review of that bookkeeping file, we can determine how disarray their books are, right? And now we can do a cleanup, bookkeeping to maximize, excuse my typos, guys. I'm trying to type as fast as possible. But now we can do a cleanup to maximize the deductions, right? All right. Now this now goes from $500 package to maybe this package is a $2,500 package, for example. And maybe we'll put them on a pay. Maybe we'll do, I don't know, 2 payments of, what's that, $1,250 or something like that. Well, you could break it out. You could maybe do 3 payments. But so you can make it affordable for your business client if you do have a client that's might be tight on cash. Okay. All right. So, but this is your process. This is where, if you're doing a full blown interpretation and analysis of it, you're going to help them understand the proposed adjustments, compare it to the original tax return. You can assist with supporting documentation or assess supporting documentation. You can determine the basis for the adjustments, and then you can actually respond on their behalf. So that might be your full-blown audit support, is where you are actually doing everything and you're responding to the actual correspondence audit, right? Now, again, if they can't or if they don't agree, they can appeal. They do have an option to appeal, but again, you need to provide that additional documentation. If you're going to appeal something, you need to let it be known what exactly you are appealing. You can request an informal conference. You can request an appeals conference. And then finally, you can petition to the tax court. So oftentimes what your clients want to do, if they do want to appeal, they'll try to appeal internally, right? You might appeal to the manager of the IRS agent that was reviewing you. You might request an appeals conference, which is an informal conference to say that you don't disagree and here's why. Or you might just want to be like, listen, let's just take this to tax court. And this is kind of for those, more serious issues that you might want to take all the way up to the tax court. Now, what the IRS says is that the taxpayer has the burden of proof, right? Like they have to substantiate their position, right? So it says the taxpayer has to maintain proper records, receipts, invoices, bank statements, relevant documents. They have documentation requirements, right? They have to be able to substantiate and be able to challenge any IRS adjustments. And then there's something called the preponderance of evidence. So it really just means, again, that the burden of proof is on the taxpayer based upon the preponderance of evidence. This means that the taxpayer must present enough evidence to support and convince the IRS or a court that their reported items are accurate and that the IRS proposed adjustments are inaccurate. So all of it lies on your clients, guys. And of course, if you're going to be assisting them with this to substantiate your position, right? And I don't know why it keeps taking me to the beginning every time I exit out. Sorry about that, guys. Let me just get back to this last part. I don't know what's going on with this. Okay. So, last couple of things is your fraudulent transactions. So this is something called badges of fraud, right? So what are the badges of fraud? Well, the IRS says that these are indicators or red flags that may suggest the presence of fraudulent activity. These are red flags. Now, it's not to say that these folks that have these red flags are committing fraud. It's just saying that these are generally a red flag that the IRS will want to investigate, and you as a tax professional and an enrolled agent, you would need to be conscious and leery of and make sure that we're ascertaining all the facts of a client's or a taxpayer situation. So number one, underreporting income. It's a badge of fraud. Inadequate record keeping or accounting practices. So it's not to say that if somebody doesn't have bookkeeping that they're committing fraud, but people that normally don't keep books or have adequate record keeping process are more easily to um, commit fraudulent activity, right? They might not report all of their income, or they might report too much expenses, for example. Engaging in complex transactions with no legitimate business purpose. So you might have a client that has 3 or 4 businesses and they got a holding account and they got a trust, and you really look at it further and it's like, wow, there's no, you can't really see where the legitimacy is at to have all of these complex structures. That could be an indicator, what the IRS says, of fraud. Providing false or inconsistent information to tax authorities. So they might, provide income to the state that's different that they were provided to the federal government, for example. That will be an indicator. Attempting to hide assets or income offshore. That's an indicator. It's not saying that they are being fraudulent. It's an indicator. It's a red flag. And then destroying or altering financial records. This will be the last indicator of fraud that could warrant some further investigation into the client, further substantiation, further questions. Now, in order for your clients to get to tax court, they will need to have already received what's called a 90-day notice of deficiency. This is your 90-day letter. This letter is their, in essence, golden ticket to be able to take their case to tax court if they don't agree with the adjustments that the Internal Revenue Service has sent them, right? So your notice of deficiency is your official letter from the IRS that say, hey, you owe this amount. This is your official notice that you owe this amount of money. They have 90 days to challenge the IRS's proposed adjustments in the United States tax court by filing a petition. Now, they do get 150 days if they are not currently in the United States. They do get that 150 days. So you just want to remember this. Guys, all of this that I'm going over is tested at some capacity on the special enrollment examination. So, if I'm teaching it, I'm not teaching it, obviously there's some bonus stuff in here that I gave to you guys because I think it could genuinely help you in your career. But this stuff is going to come up on the exam. So in order to go to tax court, what do they need to receive? A 90-day notice of deficiency. You're probably going to, you're definitely going to see that question on the special enrollment examination. So we made it. We made it to the final portion of this. So just to wrap up on the representation really quick, in your course, what I did, I uploaded my fast track lessons here. So these are kind of like the very quick condensed information that you can use to kind of quickly review this. Everything that we went over, you can kind of go back in here and quickly review it. So practice before the IRS, requirements for enrolled agents. This is the exact testing specs that they're testing you on. So you got the kind of quick version that you can refer to. Do this, read this, and then what I want you to do is in your course, you're going to take all of the pop quizzes and you're going to take the final exams within your course. And that's how you're going to feel confident that you should schedule your exam. I encourage all of you guys after this training is up next week to get an exam done every month for the next 3 to 4 months before this testing cycle ends. You have more than enough time to test this. You could test in November for representation, test individual in December, test business in January. You guys should all be EAs before the tax season ends in 2024. That would be my personal goal for you. Yes. Thank you, Shavonda. All right, let's just wrap up with some quick questions. Anybody have any questions? And I'll go back up in the chat to see if I miss any questions. So Barry said they can just come and say, pull up the file without any notice or allowing you to get the files together. Are you allowed to tell the client? Also, is it allowed to tell the client when the FBI came? Hey, Barry. So I'm letting you know my personal experience. This lady came up into my office. She says, I'm the IRS agent that's assigned to your business client. I see that you're the power of attorney over your business client. And she sat down, we talked a little bit, and she was like, okay, show me their bookkeeping, right? Because I was letting her know, I was like, listen, I just came on this file. I'm just now starting to get their bookkeeping caught up. I've only been working with them for a couple of months. And she literally asked me to pull up the QuickBooks, and I turned it over to her, turned my little screen. She was sitting on the other side, and I was kind of going through how I was getting her bookkeeping cleaned up. I honestly, Barry, don't remember. I don't remember any, there was no warning that she literally came up unannounced, unannounced. Now my client could have received some sort of correspondence that I didn't know about, you know, but she popped up. She popped up at my job. Yeah. All of you guys too. Thank you, Arita. That was nice. Awesome, guys. So I was recording this class, think. So the replay will be up by tomorrow. All the other replays are up. Even the portion that I did get recorded yesterday is up. But all right, guys. So I'll see you tomorrow, same time, and we're gonna get started with the individual. All right, guys, have a great night.